When it comes to building wealth, the stock market is the number one place. Not gold, not bonds, not real estate, even though one asset class might outperform in the short term, when it comes to long-term wealth generation and really building a portfolio, stocks are the way to go. Now, data from the Dutch Bank shows over the past 100 years, equities beat out gold by 5.6%, housing prices by 6.6, treasuries by 6.8, oil by 8.4, per year over the past 100 years, making the stock market the best place. Now, in today's video, we're going to be breaking down my three favorite and very popular ETFs, the VOO, the QQQM, and the SCHD. Now, all three of these are really easy to invest in, and in a portfolio, which one is the best one and which one should you be buying right now? We're going to get into it. So the first one on our list is the VOO, or the Vanguard S&P 500. Now, this is the best and the easiest. When you think of the greats like Warren Buffett, everyone should own a piece of the VOO. When you think of the market itself, it is about 80% of the entire stock market. It covers every industry, it covers every sector, and most investors don't beat the market itself. When you start thinking of investors, almost 90% of investment advisors cannot beat the S&P 500, and this benchmark is kind of crazy to think. It contains the 500 largest companies in the United States. Actually, it's 503 because some stocks have two class of stocks in there. When it goes to the portfolio, the VOO this year has been over 30%, which is kind of incredible. In the past 12 months, over a 30% return. And when you start thinking about the index's historical returns, it's about 10.5%. Now, you don't get it over every year, but in the long term, it has been remarkably consistent when it comes to the returns. Even looking at the VOO as guaranteed returns or generated returns of 271% or 14% annually over the past 10 years, which is kind of crazy. Even so far this year, we're seeing it up about 22. In the last 12 months, we're seeing it up over 30%. We know this is not going to go on forever. When it comes to the Vanguard ETF, and of course, I do hold this one personally in my investment portfolio with a index fee, a low expense ratio of a 0.03, which is kind of crazy. Virtually all of the money that you put into this is going and really working incredibly well for you. Now, of course, when it comes to index investing, analysts believes that it is poised for a little bit of a downturn next year, but nobody knows. It's really a question mark. They say that we could see a pullback in the VOO or the S&P 500 of roughly 20 to 25%. When you start looking at a multitude of years, if I'm investing at that 20-25% reduction next year, I am buying it at a 20 to 25% discount, which is exactly what we want. I want it discounted. I want it to go down because I'm not close to retirement and I'm still putting money regularly into the VOO. Now, the second one we're looking at in the Investco Trust Series, the one ETF is the QQQ. Now, of course, there are two variations of this, the QQQ, and there is also a QQQM. Now, the QQQM is the same, essentially following the NASDAQ 100, but it does come with a little bit less liquidity, but it also comes with a little bit of a lower fee, which is the one that I do love to use. Now, when you start thinking about the QQQ, if you caught any of the very snazzy commercials they got, it is tracks the performance of the NASDAQ 100 index instead of that S&P 500 index like we see with the VOO. Tech stocks, of course, have been leading the market to new highs, really driven when you think of Apple, Microsoft, Nvidia. They have been doing incredibly well. Even looking at the past decade, it has generated total returns of 473%, which is insane over the last 10 years. But of course, like I said, this is very tech heavy. Now, this is driven almost its entirety by two big things. Number one being the semiconductors and really how many and how big the demand is for those semiconductors. The second one is artificial intelligence. So if you're thinking in the future, we're going to have, of course, in my opinion, we're going to see a lot more that is coming out of semiconductors, much more of a demand for computing power, and much more demand and integration with artificial intelligence in a lot of different places, which means the future, there's going to be two types of companies. This is a quote I heard. There's going to be companies that embrace and utilize AI, and there's going to be companies that did not embrace AI and no longer exist. Might be a fact in the next 5 to 10 years that some of the companies that don't find the efficiency with artificial intelligence are no longer really going to exist. Now, when it comes to corporate spending, a lot of businesses paused the spending because their rates were so high, it was expensive to borrow money. the Fed raised it by or lowered rates by 50 basis points, which means money does come a little bit cheaper. If they continue into 2025 to reduce rates, we're going to see money get cheaper, meaning that institutions can borrow a lot more. And the final one, which is one of my favorites, when it comes to one that I love, it is the Schwab US Dividend Equity ETF, the SCHD. Now, all three of these, the VOO, the QQQ, and the SCHD, I do hold in my 3 ETF portfolio, which I absolutely recommend. It has been doing incredible in the last 3 years, just north of 3 years. We're up about 84% in totality, which is crazy through dollar cost averaging. And like I said before, even when the stock market goes down, if we see a pullback or a reduction in the value of the stock market, that is a great time to buy. You don't want to be selling when the numbers are really going up, when we see it running, when we're seeing record highs. Even this year, I believe I read earlier today, we have seen 47 record highs this year from the S&P 500, which is kind of crazy. But looking at the SCHD, this is very different. So the VOO was a big encompassing 503 stocks within the stock market, largest companies. When you started looking at that QQQ, it was the NASDAQ 100, very heavily focused in the tech side. This is the dividend side. So you are getting pretty much the 3 best, which I know there is some overlap. People always talk about this all the time. There is some overlap, but there's a point where one, you want a fundamental ETF, which is going to be your basis. It's going to be the core, which is that VOO. Now, of course, you can use a bunch of different variations that track the S&P 500. Doesn't really make a big difference which one you're using, but personally, I use the VOO. The second one being that QQQ. And of course, that tracks and really is the growth factor for it. When you start looking at how well the VOO performed in relationship to the QQQM with the tech-driven heavy has done incredibly well. And then, of course, like I said, the SCHD is the third one we're looking at. When you start looking at long-term wealth, the buying dividend stocks, growth stocks, is really putting any strategy on steroids. Reinvested dividends account for 85% of the S&P 500's total return since 1960. Let me read that one more time from here. Reinvested dividends account for 85% of the S&P 500's total return since 1960, which is insane. Moreover, the best performing stocks in the index go back to the 1930s, which have initially and given dividends and raised the payouts through time. They have never had a losing decade. So kind of crazy. When we think of the SCHD, that is why so many people do recommend it. One of the best investment vehicles to income generation. And of course, it consists of 100 dividend paying stocks and yields a 3.4% return. Now, the unique thing with this one is even though it is an ETF, even though it is poised as a dividend ETF, we are still seeing a tremendous amount of value out of the companies, which is the reason why, even though there's a 3.4% yield on this specific ETF, we have also seen about an 11% growth, which is exceptional. Now, it was created in 2011, established a really good track record right off the gate, nearly 11% annually over the past 10 years, which is crazy. Just recently increased its dividend by 15%, and it had a 3-to-1 stock split. Now, of course, for all three of these, like I said earlier, I am invested in these with a portfolio of, I think it's around $130,000 as it sits right now. If you look at some of the older videos where we hit the milestone of 100,000, it has grown exponentially and continues to grow this year. So guys, out of all three, what is the best ETF? Which one should you buy today? My opinion, all three. Now, I know that that's kind of a bias. Now, when you start breaking apart this and kind of how it should be bought and how you should kind of put it together, if you're in the younger generation, so we're talking 20s and 30s, a lot more heavy into the QQQ, a lot more into the stock, or excuse me, the ETFs that we have in there, focusing on the tech because you have, another 30, 40 years until you're getting ready to retire. If you're mid, so thinking 30s and 40s, a little bit less in the QQQ. So even thinking now, having about 35% in that QQQ, remaining percentages split between the VOO and the SCHD. And what I'm systematically doing with my plan is as I slowly move out of my position of the heavy tech QQQM, as I get closer to retirement, I am putting more into the SCHD. Now with the VOO, because that is the basis, that is the foundation ETF that I do carry, I'm going to keep that one at my 30%. The SCHD will essentially, as I get closer to retirement, take the place of the QQQM, not in its entirety. Now remember, if you're thinking of a target age of 65 for retirement, That does not mean, number one, you hit the age of 65, you're cashing all of your funds out, that's it, you're done investing. You still need growth out of this thing. When you start retiring at 65, you roughly have estimated 25 years of life left, meaning keeping some in the QQQ, keeping some in the SCHD with a little bit of a different variation on the percentages that you have in there. But you still want to see growth out of those tech. You still want to see essentially a growth factor in there. Not only the dividends that you're getting out of some of these, but you want to make sure that it's growing even through retirement. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.